going to make mistakes. A lot of people have never raised before. And so our solution to that is giving you information, giving you knowledge that you need so you avoid the rookie mistakes. I often say that there is no fundraising secret. There's only poorly informed founders. And so we're going to try to resolve that today. So today's agenda, as much value as fast as possible, financial instruments to raise your round, 3 types of instruments, confidentiality, data room, NDA, what you should do, what you should not do, SEC exemption, so that's in the US in particular, there are laws, right? Raising funds is a regulated activity, so we'll cover that. And the last point that I know everybody wants to know is, 1, do I need a lawyer or not? And 2, how much is it going to cost me for real? Because that's always the painful point. So this should take like 40 to 50 minutes. And then after that, we'll try to keep 10, 15 minutes at the end for Q&A. So again, if you have questions, please drop them in the chats in the right hand of your screen. Leave your questions here. Please turn off your microphone and your camera during the presentation so we don't disrupt each other. And just as a reminder, this presentation is for tech companies raising venture capital. So you're welcome to stay if you're doing something else, but all the advice, all the suggestions, all the things we're going to discuss is for those companies that are, raising from VCs or angels and are in the tech space, right? Which is quite specific. Okay, so that's the big picture. And now it's time to welcome the man of the hour, one of the best startup lawyers in the US, Omeed Tabiei. Omeed, please join us.
Thank you, Stefan. Hey, everyone. I'm Omeed. I'm the managing partner at Optimist Legal. We're a boutique law firm. What that means is we're a small law firm. So 4 lawyers at the firm. All of us have worked at the world's largest, most spectacular, best law firms in the world. Worked at some of the top startups. So for example, I was one of the early lawyers on the team for a company called Hyperloop, which was a super fast train that would take you from LA to San Francisco in 30 minutes, as opposed to the 3 hours that it normally would take you to drive, or the hour that it takes to fly. I helped the Hyperloop team raise over $100 million, grow from 60 employees to over 300 employees, and help them build the test track and so on and so forth, hire some of the world's best talent. That's where I started my career. From there, I've gone on. I've worked with most of the top startup accelerators in the world: Plug and Play, 500 Startups, Draper University. I've been in the startup space for a long time. And part of my story as well is, being a lawyer, I was very inspired by a lot of the tech startups that I helped support. And that inspiration actually inspired me to start 2 software companies of my own. And one of them was VC backed, one of them was bootstrapped. But after being a software founder, I essentially, I was like, oh, being a founder looks really cool. And then I was a software founder and I was like, you know what? Actually, I think I like being a lawyer better. So then I went back to being a lawyer, because being a founder is really difficult. So that's a little bit about my story. Now at my firm, we've been around for about 4 years. I started the firm about 4 years ago. We help startup founders across industries. We primarily help startup founders with all things contracts and data privacy as well, but primarily all things contracts. So starting your company, issuing equity, safe rounds, price rounds, convertible notes, master services agreements. If it has to do with contracts, that is what we help founders with. We also help founders with exit. So we've done quite a few deals where we've helped founders sell their company as well. So the entire life cycle of your startup is essentially what my firm helps with, anything that has to do with contracts. So that's my background. I'm going to drop into the chat my LinkedIn so that you can connect with me. My LinkedIn is now in the chat. And Steph, it looked like you were going to say something.
Yeah, just want to say thank you for being here. For everyone who doesn't know Omeed, he's a great lawyer. He's also a great communicator, and that's really something I appreciate with you, man. The way that you can make something very, boring and sorry, I know it's your job, but I can say it. It's not mine. Something quite boring and that is frustrating for other founders, approachable. So that's something I really appreciate. Really amazing at that. And in that spirit, let's start with just a few key terms. And for everyone in this webinar, the way it's going to work is I'm going to play the founder's role. I'm just going to ask Omeed all the key questions, right? All the stuff that you must know. I'm going to ask the questions. Omeed's going to answer. And we're just going to go like that back and forth for 40 minutes. Anything unclear, any questions, drop the questions in the chats and we'll cover them in the Q&A at the end. And so, Omeed, let's start with a simple one. What are the key words that I need to know if I'm going to raise? What are the key concepts? We talked about safe. We talked about price round. Like very quickly, what's what?
Yes. So when you're raising funds, the type of instrument that you use to raise the funds is incredibly important. And what I mean by the instrument is the type of contract. So the contract that you choose is going to determine how the deal is done. Most early stage founders that are, for example, pre-seed or in the angel investment stage, that would be when you start your company, are going to use a SAFE, which is a simple agreement for future equity. Most startup founders have heard of the SAFE because it's just become such a popular contract. So the SAFE is the first contract that most startup founders will use in the early stages of fundraising. Then there are what are called convertible notes. Convertible notes are essentially debt or a loan that converts into equity, usually when there's a priced round, or they could also convert upon other events, but typically it's a priced round. Then the last type of fundraising instrument is the standard priced round, which is just a stock purchase agreement and some other contracts. But a price round essentially just means you are selling equity at a certain valuation, which is very different than, for example, the SAFE or the convertible note, where you're actually not having a conversation around setting valuation for those contracts. And that's the benefit of those contracts, which we'll get into a little more into those concepts farther into the presentation. So those are the three types of fundraising instruments that founders need to know about. It's the SAFE, convertible note, and then the priced round stock purchase agreement.
Okay, and so that's really that was very confusing for me when I started in the space because I thought I'm going to raise funds, so I'm going to give equity in exchange for cash at a certain valuation. And actually, most likely not, because I'm going to raise with SAFE. And so that's not what happens. I also read a number that in the US, most rounds under $2 million are done with SAFE. Does that sound correct to you?
Absolutely. And, that has changed significantly over, the last decade or so. So I'd say in the last few years, for sure, we're seeing, seed rounds, $2 million be raised with SAFE, which in the past, that was actually unheard of. But yes, that is absolutely true. Even seed rounds are being raised via SAFE agreements.
Okay. So more and more SAFE. And we'll get to that. Well, let's deep dive. Let's double click on the SAFE.
Sure.
Tell us a little more. So I'm a founder. I have a standard simple contract that I'm gonna go around and give investors. They sign it. They wire the money. Is that how it works? And then what's inside the contract, like the simple stuff, the key stuff?
Sure. So the benefit of a SAFE is that you actually don't like have to have that conversation with investors around what valuation is. SAFE is a template contract. It was developed by Y Combinator some years ago, I think, 10, 15 years ago now. And it has become such a standard in the world of startups that it's widely accepted as a template document. So what does that mean? What that means is if you take this contract that you can download off of the internet and you take it to an investor, the investor is going to be incredibly familiar with that contract, and you're not going to have to do much negotiation around the terms of that contract because it's become such a widely accepted contract. So, how does the safe work? Well, the safe has some primary terms that will be negotiated. Now, I said that the benefit of the safe is that you don't have to have a conversation around setting valuation, because in the early stages, it's going to be difficult for you to say, yes, my company is worth $10 million, for example, so I'm going to raise at a $10 million valuation. Instead, what you'll do with the safe is the terms that are negotiable and that you will negotiate with an investor are what's called a valuation cap, which essentially means that you're going to cap the valuation of the safe at a certain amount. You're going to set some valuation that will not be exceeded. And that's the valuation at which the investor's money converts. And if the lower the cap is, the more equity essentially you're giving away. So oftentimes, for example, early stage startups will raise, somewhere between a $5 to $10 million cap because your idea hasn't had any traction. You haven't really had a strong understanding of what the actual valuation of the company will be. But essentially what happens is, let's say you go and you raise a later round, a priced round at $20 million. If you gave your safe investor a $10 million valuation cap, their valuation for their investment will not exceed that $10 million, even if the valuation is set at $20 million for the later round. So that's the benefit to the investor, essentially. So one of the first terms in the safe is going to be a valuation cap. Some startup founders, for example, may not be able to set a valuation cap. The investor or they don't want to. Instead, what they'll offer is a discount. So these are the two primary terms in the safe, is the valuation cap and the discount. And they essentially have the same function in different formats. The discount essentially says, okay, if you go raise at a $20 million valuation, but you give the investor a 20% discount, they will receive the shares in the priced round at a 20% discount applied to the $20 million valuation. So it's the same as, you go to the grocery store and you buy a product, for example, that product is $5, you get a 50% discount. Instead, the product is $2.50. Same concept applies. Now, some safes will have a cap and a discount. And in those instances, the investor gets the cheaper option, essentially.
Yeah.
Whatever gives them the best terms is what they get, is what they get applied. If it's the cap, then the cap is applied. If it's the discount, then it's the discount that's applied. So those are two of the most prevalent terms that you'll find yourself negotiating in the safe agreement. And then the other thing that people need to be aware of with respect to safes is, are you using a pre-money safe or are you using a post-money safe? And that just has to do with how the valuation is set. So pre-money essentially means what your company is worth before new money comes in, and post-money is what the company is worth after new money comes in. And the difference between those two types of safes is, as I mentioned, post-money is what your company is valued after the investment is received. And so the benefit of the post-money safe is you actually know specifically what dilution you're going to be offering essentially to investors, as opposed to pre-money causes some dilution issues in terms of the cap table modeling. And so that's something that you definitely need to keep in mind in terms of, what type of instrument you're using. And those are primarily the concepts that you're going to find in a safe.
Okay.
Valuation cap, discount, and then whether it's a pre-money or post-money safe.
Okay. So I'm going to do a bit of cleanup here in the guest list. So we have a question. Matt, I think this will help people. What are typical cap and discounts? Can you give rough numbers, what the standards? Because that would just help, for everyone to get a sense of what's normal or not normal.
Yeah. So as I mentioned, typically for angel stage, you're going to be raising at a cap of somewhere between 5 to 10 million is typically what the valuation cap is for, most investments in the angel stage. And a lot of mechanics will go into that because, as I mentioned, it's really difficult to value your startup in that stage. But let's say you're a founder who has had exits before, for example, or you're, a Stanford dropout or graduate, either one, or you're ex Uber, ex Facebook. These are, what is going to make you have more leverage in the negotiation, essentially, to, set a higher cap. So, um, so in so the cap is as I mentioned usually somewhere between 5 to 10 million for the angel stage investments, and then the discount, it typically is like a 20%,
20%. Yeah,
20%,
that's what I'm
20
seeing. Yeah.
20% discount. Yeah.
Okay.
But, again, these sorts of things are all about leverage. And so you want to utilize, all of the tools at your disposal in terms of how you choose these terms, and working with your lawyer and your advisors, is strongly recommended.
Okay. So we need to move on because we have so many topics to cover. Someone once explained SAFE to me as you will have a Series A later and there will be a valuation later, but you need money before that. And so people will give you money. And so they take extra risk. It's like they give you an advance on the Series A, right? The pre-seed or the seed are advances on the Series A. And so you reward them with a discount or with a cap, basically. That's how the investor gets a reward versus the Series A investor, right? Because they get slightly better terms, like 20% more shares for the same dollar, right? Is that a, yeah?
Yeah, that's exactly right.
Cool. All right. And then the floor, we didn't mention the floor, but the floor is another clause that protects the founder, right? Because the cap and the discount protect the investor and the floor protects the founder. And
That's
then we
correct.
have the whole spectrum of a safe. Convertible notes are not so used. So like as a founder raising in the US, do I really need to care about it? What is, or can I just, skip it?
Well, so I think the benefit of these are essentially just the various capital instruments. So I think that founders should be well versed in all of the instruments that are available at their disposal so that they can, essentially play in the world of finance. Because if they're going to grow their startup, most startup founders want to uh, have a startup that's going to be worth $1 billion or 100 million or however much it is. And if, the startup wants to have a very successful, the startup founder wants to have a very successful startup, they need to know how to play in the world of finance. So should they know about it? Absolutely. But convertible notes are typically used for what are called bridge rounds, because they are loans. They really operatively function as loans or
Okay.
debt, which is, different than a safe, for example, which is an equity financing instrument. So yes, they should absolutely know what a convertible note is, and they should know how it functions and how they work.
Okay. So safe, notes, and then the price round. So that's the real equity round with evaluation and the term sheet and all that stuff.
Yes.
So can you break it down for us? And we're running out of time, so we're gonna have to do it quick.
No worries. So as I mentioned, convertible note is debt, and then a price round is where an actual valuation is set for the company. So, and it's usually negotiated between the investor and the founder. And there's a lot of there's a lot of speculation that's happening in the setting of the valuation. Uh, but how founders usually will go about valuing their companies is you can, run comps. For example, you can go look at the market, similarly situated companies that are similar to yours. What valuations have they, raised at? For example, founders are always asking me how they, set the valuation. There are various methodologies to do that. But with respect to a priced round, what people need to know about price rounds is there's a process to the priced round stage of investment. So it typically starts with a term sheet, and the term sheet is essentially a summary of the key deal terms, and it's going to be, what is the valuation that's being raised at, and that valuation will price the shares of the company at a certain amount. So, we're going to sell our shares at like a dollar. Steph, are you saying something?
Yeah, I was asking, so setting the valuation is like setting the price of the company, right? When we say
Yes,
there's a unicorn, $1 billion company, it's $1 billion valuation, right?
that's correct. And that $1 billion valuation essentially will price the shares at some dollar value. So, um, the term sheet is going to set that valuation, which is the price of the company. It's going to tell you how much money that the investor is putting into your company. It's going to go over the rights of the investor. It's going to say whether the investor gets a board seat. It's going to set the liquidation preference, which essentially says what liquidation preference is. When you go to sell your company, if the investor has put 10 million into your company, for example, and there's a one-time liquidation preference, they're going
Mm.
to make their $10 million back. So it's going to say, what their liquidation preference is. And then typically term sheets are non-binding, which means that they're not legally enforceable. It's just
Mm.
essentially, saying like, hey, I'm interested in these terms in your company, but I could change them at any time. And if I pull out, you can't sue me. There's nothing you can do. But once a term sheet is signed, I'd say that the deal is about 90% done.
Yeah, it's rare to renege on a term sheet, but it can happen, right? Until the money's in the bank, anything's possible,
Yeah,
right?
don't count your money until it's in the bank.
Yeah. And so term sheet is also where dirty stuff happens, right? Where you can have sneaky little clauses that, come back to bite you 5 years later. And that's when you lose your company. And like, tell us about these horror stories. I mean, I know you have a lot, just one or two anecdotes. And as a founder, what clause I should be worried about?
Yeah. Yeah. So the most common one I think that founders experience is what's called the option pool shuffle. And the option pool shuffle is essentially where the investor requires you to create an employee stock option pool pre-money. So before the investors invest, they're going to make you adopt an option pool, which actually dilutes you and it makes their investment more valuable, so they get a larger percentage of your company. So this is something that's like very common, and investors have a lot of leverage and they know it. Um, Now, that's the case, except if you run, a competitive process and you have multiple investors who want to invest in your company, and then you can leverage them against each other. But for most people, investors have quite a bit of leverage. So they're going to say, hey, I'm not going to invest until you adopt the stock option plan. And I want the stock option plan, for example, to be
Yeah.
20%. And one of the ways that you can combat against that is actually go into the negotiation armed, for example, with a hiring plan. So, you build out your org chart and you essentially assign equity to all those people, and you show the investor, actually, we've planned our org chart for the next 5 years. Here are all the people that we're going to hire. We actually only really need a 10% option pool. So the 20% option pool that you're asking for isn't really applicable here based on this, hiring plan. So that's one way that you can essentially fight back against the investor's requirement to increase the option pool. Because if the investor says, hey, we want you to increase the option pool before we invest, you really have two options. You can say no and see how they respond to that. They might say, well, I'm not going to invest unless you increase the option pool. If you have other investors that are, willing to play ball, that's great. If not, then you're going to have to, wiggle and wrestle against their ask, essentially. So that's one of the dirty clauses, the most common dirty clause that you'll find in term sheets. Another common dirty clause that you'll find in term sheets is what's called participating preferred.
Oh yeah.
So participating preferred is known as a double dip, and it's where the investor gets to make their investment back. So as I mentioned, if they invest 10 million, they'll get their 10 million back. But then if they're participating as well, then what that means is investors get preferred stock in your company. And preferred stock essentially places them in line as first to get repaid. But then they can essentially convert that preferred stock to common stock and participate in the remainder of the round. So they'll make their 10 million back versus a liquidation preference. And then if they own, for example, 10% of your company and you sell for 100 million, they're going to make another 10 million on top of the 10 million that they got from their liquidation preference. Now, this is a dirty clause because there are multitudes of stories out there that result in the investors making more money from an exit than the founder themselves, where the founder goes and gets a really nice exit. Maybe they sell for $100 million and the investor, for example, walks away with 60 million, for example, of that investment. Or there are some instances where founders have walked away with zero from the exits because of this clause specifically. So these are some of the dirty clauses that you might find in a term sheet.
And I know one such case personally, not me, but a friend of mine, a German entrepreneur, built a marketplace, B2B marketplace, exited 150 mil, left with, the numbers after the comma, right? Like very, very little, just because, didn't hit the milestones. I mean, he also, and that's, I think, something that a lot of founders do. Things go well, they accept terms because they optimize for valuation rather than optimize for the terms. And that's very, very, because they're obsessed. I think it's emotional, it's psychological. Like founders want to announce they're $1 billion company. So they're going to push the valuation up and accept bad terms. Then the economy changes, something goes bad, who knows? They cannot raise the next round, and they die on the halfway, right? And they got, like, he spent, I think, 6 years on that company. And he left with like nothing. That was like, he told me the whole thing. It's heartbreaking.
Yeah. I wonder where his lawyer was in that situation as well, in terms of like advisors, lawyers. And I think the other thing sometimes that founders, like, they don't, it's really, you find an investor, let's say, they're a tier one investor, for example, you really love that investor. There's excitement, there also is some cost fallacy, like you've gone too far down the road with one investor, for example. Other times, like, founders don't see, they're like, oh, well, I really need this money,
Yeah.
Okay, well, you really need this money, but you don't need it at a valuation that's going to like sink your company when you exit either. So
The one you just mentioned, we have a term for that at OpenVC. We call it the drag and drop. So an investor gives you a term sheet, and things go great. and you think that, okay, you can stop other conversations because this is going to close, right? But then they drag things, they drag things, they drag things. And then you've stopped all conversation. It's been 6 weeks. Now your round is cold. You just have these guys and you are so excited and now you're so scared. And they tell you, okay, we're going to do the deal, but, and they add one or two clauses and you're going to take them because now you have no time, you have no cash, and you have no leverage. The drag and drop.
I love
We
it.
have a little post about like all those dirty techniques. It's hilarious.
That's awesome, man.
Yeah, yeah. Okay, let's continue.
Yeah. So let me just finish up the priced
Sorry,
round.
sorry.
No
Yeah,
worries, no
sorry.
worries, no worries. So with the price round, we were essentially going through the term sheet. We just talked about some of the dirty clauses that you'll find in the term sheet. Let me tell you about the suite of documents that will be found in a priced round. And what I mean by suite documents is what are all the contracts that a price round is made up of. Now, first, before I tell you about the contracts in the price round, just like a safe, there are what are called NVCA standard documents. It's the National Venture Capital Association documents. These are also template documents. And in these template documents, there are certain clauses that are essentially negotiable, just like a safe. So in the safe, we talked about valuation, valuation cap, discount, and whether it's pre-money, post-money, and then Steph also talked about the floor. Well, in the NVCA documents, the suite of documents or the contracts that you're going to find are a stock purchase agreement, which is the actual contract that sells the shares to investors. And it'll have certain reps and warranties and closing conditions. And that's the sale of your company's equity and you're making certain promises about the company's condition in that contract. Some of the promises that you might make, for example, like one of the ones that we see most often is you're going to promise that, for example, you've done all of your securities filings, which we're going to touch on here. For example, oftentimes founders, when they're raising, a pre-seed or an angel round, they don't even know that they have to make securities filings. They don't know that they have to do a Form D, for example. Well, they're going to have to file that Form D prior to raising their price round because they're going to make a representation that says, hey, we've done this. So you can't make that promise if you haven't. So that's one of the documents that you're going to find. Another document that you're going to find is the amended and restated certificate of incorporation, and that's your company's charter. That's how you're going to create preferred stock classes if you haven't already. Most founders don't, but it's going to create the preferred stock class that the investor is going to get that positions them first in line to get paid. And then that stock class is going to have some corresponding rights. And that preferred stock is what gets liquidation preference, dividends, conversion rights, so on and so forth. That's the backbone of the deal that investors are really going to look for. There's going to
Okay,
be
awesome.
an
Sorry.
no, it's okay. Investor rights agreement, which it'll give the investor information rights, registration rights, preemptive rights, and it essentially gives investors visibility and optional participation in future rounds. There'll be a voting agreement, and then maybe a right of first refusal, co-sale, and then a management rights letter, which is essentially just a compliance document. But those are some of the documents that you'll find in a price round.
Awesome. Okay, so now we have the comprehensive picture, or almost like the key stuff for safe convertible notes priced round. Now, another big question we have is confidentiality. And a lot of founders are like, okay, I'm going to raise funds. I'm going to share stuff with investors who might go to competitors, fund competitors, or just, share my deck behind my back. So I have only one question because time is running out.
Sure.
NDAs. Do I ask for an NDA? I go to an investor, I say, okay, I'm going to share my deck after you sign this NDA. Yes or no?
No.
Okay, so what do I do?
Emphatic no. One of the
Why no and
best,
what do I do?
yeah, I mean, one of the ways to be labeled amateur and to have an investor essentially never respond to you is to ask for an NDA in the early stage. Typically, term sheets will have confidentiality provisions in them. So you don't, at that point, though, you'll have established a relationship. Okay, use a data room. If you're worried about competitors, like ask about the portfolio of the investor at your pitch, for example. You want to be doing due diligence on your investor the same way that they're going to be doing due diligence on you. And due diligence starts from the very first conversation with the investor because that's what they're essentially, that's how they're approaching you. So approach them the same way. But don't ask for an NDA. What you do is you essentially just phase the release of information.
Mm,
So the pitch deck is all the exciting stuff, all the kind of like public facing exciting stuff. And then they're really going to dive into your company post term sheet. That's really when they're going to do the really deep dive. You shouldn't be doing like tech reviews with them pre term sheet. You should really be pushing them to give you a term sheet, gently. There's like a political, diplomatic way to do things. But yeah, it is your job as the founder to really, push the conversation along and get that term sheet in front of you, or, tell the investor, hey, you're gonna have to, excuse my language, shit or get off the pot, man. Like either you're gonna put a term sheet in front of you or I'm gonna keep moving. So no NDAs, use a phased approach, use a virtual data room like DocSend, for example. Um, and that way you can track what they're looking at and what information you're releasing, and then use a phased approach to the release of the information.
perfect. Okay. So that was for confidentiality. I think now that's clear for everyone. Everyone heard you. There is no confusion possible, no NDA on first contact. That's what amateurs do. Now we're going to dive into the most crunchy part of the webinar, SEC exemptions. So this is scary for all founders because one, it's regulatory stuff. So there are consequences. If you get it wrong, it can be very bad for you and for your company and for you personally. And two, it's complex. So let's try to keep it simple.
Sure.
What are exemptions and which one should I use and why?
Yeah. Yeah. So we'll start like super high level. What is the SEC? The SEC is an agency in the United States government that regulates the sale of securities. So when you issue equity, you are selling securities. Even with a safe, you're selling securities. So for example, when public companies IPO, they have to, do quite a lot of legal work with the SEC in terms of filing forms because, they're selling securities. Now, startups have certain exemptions from all of that legal work that they have to do for the sale of securities. There are two primary exemptions. The two primary exemptions are a 506B exemption, which some people explain the 506B exemption as the B stands for your buddies, in that if you are selling equity in your company, or you are getting investors that you personally know, as in your buddies or your friends and family, for example, they fall under the 506B exemption. 506B exemption essentially says, hey, if you know these investors personally, then you fall under this exemption. You don't have to register your securities. So that's the first type of exemption. The second type of exemption is a 506C, which is a general solicitation. So if you like go and post on Twitter, for example, hey everyone, I'm raising money, I'm accepting founders, that is a general solicitation. And then you will have to verify that all of the investors are accredited. My suggestion is you do that either way. But for 506C, there has to be validated paperwork, which usually is in the form of a questionnaire, or you can use a platform, for example, Invest Ready, to verify your accredited investors. But 506C will require you to verify accredited status, verify accredited investor status. What is an accredited investor? An accredited investor is an investor that makes $200,000 a year as a single person, $300,000 a year as a married couple, or has $1 million net worth in assets. And the questionnaire will verify those things. So these exemptions, as I mentioned, make it so that you don't have to file all types of registrations. If you think about public companies have to do 10Ks, 8Ks, S1s. There's all types of, very onerous legal paperwork that companies that are not exempt from registration have to do. The exemptions make it so that you don't have to do all of that registration paperwork. You can file a very simple Form D. You're going to need a lawyer. So work with a lawyer on anything that has to do with the SEC. Don't try to play SEC lawyer.
Yeah, we'll get this. Will be the last question actually, and I know it's one that people always ask: do I need a lawyer? And when and how much is going to cost me? Because everybody here is a founder, so budget is always a concern. So I know you talk openly about those things, so this will be a good question. So to summarize, I cannot just raise from anyone, and I cannot by default just go to LinkedIn and say, hey, I'm raising, who wants to invest, right? There are very strict rules, and so I have to fit into one of those exemptions if I want to raise. So I have to select an exemption, and then I know what I'm allowed to do, right?
That is correct.
That's correct. Okay.
Yeah.
So to be clear, someone is asking, with 506B, I don't need to accredit my investors. My investors don't need to be accredited.
So I would recommend in a 506B or a 506C that you accredit investors either way, because under 506B, you can only have up to 35 unaccredited investors. And there are certain requirements for non-accredited investors that make it, again, more onerous. For example, the unaccredited investors have to have verified experience as an investor, for example. So it causes complications when you raise from unaccredited investors. So I would, first of all, suggest that you only accept money from accredited investors and you verify the accreditation for a 506B or a 506C. But if you absolutely have to raise from unaccredited investors, you're going to have to 100, either way, you're going to have to work with a lawyer. But some founders, can get by, not working with a lawyer. For example, if they've raised before, they know the process, so on and so forth. But if you raise from unaccredited investors, you're absolutely 100% going to have to work with a lawyer.
Okay. So something that was helpful for me to understand this whole mess, like why is there all those rules? I think it's because the SEC wants to protect people from getting scammed, right? So anyone could start a startup, go with a pitch deck and raise and scam people. And so the SEC is basically telling, if you raise from rich people, so accredited investor, rich people or knowledgeable people, then they're responsible and they can afford the loss, right?
That's
and if
correct.
you raise from family and friends, well, it's your reputation on the line. So, it's their problem. And so this helped me, understand like why all this mess.
Yeah, we didn't even talk about like blue sky laws, which is like the state level, which is like adds a whole nother level of mess to things. But
okay.
Yeah.
So that's gonna be for
next time
for this webinar. The last question. Okay, we have still 66 founders. Cheers to everybody, by the way, because you guys still here. We started 72. We only lost 6 people on this very rough topic. So I'm very proud of everyone in the room. Thank you for sticking with us. Last question. I'm a founder in this room. I'm gonna raise 1.5, okay, in the US. Do I need a lawyer? So I'm gonna do a safe, most likely. Do I need a lawyer? And if I'm gonna raise 5 on the price round, do I need a lawyer? And then how much am I going to pay in each case?
Yeah. So for either scenario, you will need a lawyer. For the safe, you are going to pay somewhere between $2,500 to $5,000 for the legal work. As I mentioned, there are SEC requirements in terms of filings, and so based on that, you are going to work with a lawyer. And then for the price round, definitely need a lawyer for the price round. Because for the price round, you're likely working with very experienced investors who they themselves have lawyers. So for the price round, for the 5 to 10, if you're going to be, raising around 5 million, you're going to pay somewhere, between 35,000 to 50,000, depending on what the state of your company is. And how much back and forth, but we do fixed fees for everything. So if you come to us, we will set a fixed fee for the raise, and you'll know going in, this is what you pay. But as I mentioned, for the safe round, 2,500 to 5,000, depending on how many investors there are. For example, like we had someone who had like 60 investors, for example, in all
Yeah.
different states. And that can be quite messy in terms of the SEC filings and the Blue Sky filings. So an instance like that, you can expect to pay like 5,000. But if you have a handful of investors, maybe 4 or 5, all of them in the same state, then you're going to pay somewhere closer to 2,500. And then, as I mentioned, for the $5 million price round, you're going to be, looking to pay somewhere between 35 to 50,000.
Awesome. So we heard the truth from Omeed. Thank you, Omeed, for being so transparent.
Sure.
We're almost at the end of the webinar, but the best part has yet to come, the Q&A. We have questions from the crowd. I'm going to read them to you, Omeed. And if it's okay, I would like to start with my own question.
Sure.
Because I have a question for you, Omeed. So I'm raising a priced round with VCs. Do I have to pay the VC fees, the lawyer fees of the VC? Because I heard that. So is it true?
Yeah, this is a fairly common practice where essentially the VCs will say, hey, we're going to invest $5 million. It typically is, for Series A round. And they essentially will say, we're going to invest $5 million, but you have to pay our legal fees. And this is another one of those instances where most founders uh, agree. And they agree because they're like, well, the investor is investing the money. We really need the money. And usually the investment process also is like, there's like so much excitement, and, you like love your investor. You're like, oh my God, this guy's like putting the money in.
Well, they believe in you, so you
Yeah.
have to love them.
Yes, exactly. So yeah, I mean, it's a common
Yeah.
practice where you have to pay the investors legal fees, but it's becoming, depending on, again, your leverage, makes it as to like whether you can push back, how you push back, and that sort of thing. But yeah, it is a common practice.
Awesome. Okay, let's dive into the audience questions. Just Omeed, checking with you. Do you have a hard stop in 6 minutes, or can you drag a little longer?
No, we can go longer.
Awesome. Awesome. You're the best. Okay, let's do it. So someone is asking if the payment for the lawyer happens before the price round or after closing the price round.
Yeah, so it would be after closing the price round.
Okay, so that makes things easier, right?
Yeah,
Use the money of the round to pay the lawyer.
that's right.
Okay. There was a question about SPVs, RUVs, and SAFE. Are they the same thing? Are they different things? So can you clarify for people here?
Yeah, so an SPV stands for special purpose vehicle. It is absolutely different than a safe. Sometimes people use SPVs to consolidate. For example, if the cap table has like 40 or 50 investors, investors hate really messy cap tables. So when you go to raise your Series A, you'll use an SPV by putting, all of those safe investors into an SPV to essentially clean up your cap table.
Okay, so that's super clear. So the SPV or the RUV allow me to bring a lot of investors into one line in the cap table.
That's
And the
correct.
SAFE is the contract. So it's two different things.
Yes.
Okay, awesome. Thank you. Another question, a good question from Kamali. Really, I never thought about it, but if you're raising a very small round, like 100K USD, what would the pricing look like for SAFE? Are you still going to spend $5,000 on that? That's like 5% of your round.
No, definitely not. If you're raising like 100K, I mean, again, it depends how many investors, right? So if you're raising 100K from one investor, you're going to be paying 2,500 for the filings in terms of the Blue Sky and the Form D SEC filing.
Sorry, I didn't catch the number. Can you repeat that?
2,500.
So okay, so that's gonna be like the floor.
Yes.
Okay, no, not the safe floor, but the floor.
Yes.
409A. So do I need a 409A? When do I need it? And maybe what is a 409A for everyone listening? Maybe not everyone is familiar.
Yeah, 409A is evaluation. So it's a setting of evaluation, and typically the 409A, you can go to platforms like Carta. I think the 409A on Carta is like $3,000 or something like that. You pay Carta, they will and the 409A is typically, well, it's not typically, it is required when you start issuing stock options. So the reason why you get a 409A is it essentially, sets the price for the options. And so people who are receiving the options know when they're what's called in the money, where the options have increased in value. So the 409A is required under the Safe Harbor Act, which is an SEC regulation, um, when you are issuing stock options, when you adopt your stock option plan. And typically you will adopt your stock option plan. Some founders do it earlier on, but for sure at the Series A stage, you're going to have a stock option plan. So that's typically, somewhere in there you will get your 409A.
Awesome. And I see that Kamali has a meeting with an angel in 30 minutes. So we're rooting for you, Kamali. We hope this is helpful. Omeed, a few people are asking to connect with you. Do you allow me to share your email address directly in the chat?
Absolutely. Yeah. Please do share my email address. Also, I've dropped my LinkedIn in the chat. I'll drop my LinkedIn in the chat as well. Anyone who's still here, please DM me. I have, a resource that I would love to share, which is a fundraising guide. The guide goes through everything I've discussed on this meeting today, and it will, go in depth in terms of not only the things that we've discussed, but how to address them as well in terms of negotiation tactics, tips, tricks, that sort of thing. So shoot me a DM asking for the fundraising guide, and I will respond with a copy of that guide for free for anyone who's still on the call.
Awesome. And I'll ask for one too for myself, if that's
Sure,
okay.
of course.
Okay. Okay, let's do a fire round, like yes, no questions. Do I need a 409A if I only have a safe or priced round money without any options?
No.
Okay. Um, Is a SEC filing required for every safe investment? Example, just 25K from family and friends. Is a SEC filing required for this level of investment?
Yes.
Sorry, Craig. I don't think he's going to like this answer. Do you have to obtain consent from each safe investor to fold them into an SPV? Or can you do that unilaterally under a safe contract?
No, you'll have. So the short answer, no, you cannot
You need
just.
consent.
Yes,
You
you
need
need consent.
Yeah, you cannot just like
Shove them into an
show them.
SPV.
Yeah, thank you. My English is not good enough. Yeah, show them. Is it a good idea to patent your IP before contacting investors?
No.
Oh, okay. Why not?
Well, I mean, it
Sorry, I'm
depends on,
curious. Now I'm curious.
yeah, it depends on your company. If you're a software company, the value of the patents is not that great, especially in the investment stage. I would say that the patents become incredibly valuable at the time of exit, for example, because then you have like an asset that you can sell to the acquirer. But do I think that you have to have patents before you reach out to investors? No, I think that most software companies actually don't move to get patents before they contact investors. And I think that actually, if there are patents, there's usually an IP strategy, and that IP strategy is something that you would pitch to the investor, and the investor would say, "Oh, I like that IP strategy. I'm going to invest." And a certain portion of these investment funds are going to go towards executing that IP strategy. Patents are
Mm.
expensive.
Oh yeah, they are. I know. Actually, my previous company was in deep tech. That's why I was curious to get your thoughts on this.
Yeah.
A lot of fun. I don't recommend it. Okay. Next question, and we're getting close to the end. No, not this one. Where was this? Sorry, I had it and then I just slipped. Okay, yeah. How many investors is too many investors for pre-seed? Like, can you have just one investor? Should you have many? Like, what's the right number of investors for pre-seed round?
It's an interesting question. The right number of investors for a pre-seed round, it actually has to do more with dilution. So you actually really want to be modeling your dilution in the pre-seed round. You definitely don't want to give away more than 20% in your pre-seed round. So it is less about number of investors and more about how much are you actually giving away in the pre-seed investment round. I'd say that's the first thing. And then, as I mentioned, investors hate when your cap table, for example, has like 60 angel pre-seed investors on it. So you definitely, but if that's the situation that you're in, and that's the only way that you can get the money, and the money is absolutely crucial for you to operate your company, then there are things that you can do to deal with it. As I mentioned, for example, set up an SPV, and that'll address the cap table messiness. But I think the first thing that you should be thinking about is modeling the dilution to make sure that you're not giving too much of your company away, because that I think is more of a deal killer in later rounds than it would be having a very messy cap table.
Okay, so that's very clear. Okay, we still have time for one or two questions, and then we can call it today. Is that okay
Sure.
with you, Omeed?
Yeah.
All right. What is? Oh, so that I have an opinion on that, but you're the man of the hour, so it's for you. What is a reasonable amount to pay introducers? Should it be 100% success based? So people who introduce you to investors.
Yeah, the reasonable amount to pay to introducers is $0 because unless they're a registered finder broker, you cannot pay people for introductions. That is considered a success fee, and success fees can actually land you and the investor in a lot of trouble with the SEC, because they have to be registered and licensed to be able to make introductions. This is like one of the like top questions that I always get from people, especially like people that have a lot of connections to investors. They always come to me and they're like, "Hey, I have all these connections to these investors. How can you help me structure it so that I can make introductions?" And they're like, "Well, can't you find some sort of a loophole?" No, the only way that you can pay someone for introductions is if you were paying them, for example, a consulting fee. Let's say you were to hire an investor relations person. You're not paying them directly for the introductions. You're paying them to do a job, and it actually doesn't matter whether they make any successful introductions or whether they do make successful introductions. If there is a success fee, that is a violation of the SEC regulations. You can be barred from ever raising investment ever again, and the investor will be prevented from making investments in the future. Success fees are not allowed with respect to introductions. The proper way to structure them is as a consulting fee that is paid either monthly, or the other way that it can be structured is, let's say the person is a marketing person and they make an introduction to an investor. And as a result of that introduction to the investor, they get a job at your company. They actually have to provide the services under that job. Those are the two most prevalent ways to structure these sort of investor introduction relationships.
So that's a really great answer, and you really like covered the legal aspect of that. I'd like to add something to it, just because it's something that I see a lot at OpenVC. There is also a kind of relational aspect to it. In the US, especially at early stage, investors don't really like introducers. It's a cultural thing. Okay. In China, in the Middle East, you'll have a lot of introducers. It's very well established. In Egypt, it's very well established. In the Anglo world, US, UK, it's kind of frowned upon because investors believe that it's the CEO's job to raise, and they want to build a relationship with the CEO. And if the CEO cannot raise, they consider he's not good enough or whatever, and he doesn't understand the rules of the game. Now, you can have your opinion on that, but it's just not going to give a good image, especially at early stage. If you're raising a Series D, yes, you're probably going to have an investment banker, and you're going to have the certifications that Omeed described. But at early stage, there is this also thing. And then the model, economic model doesn't really work. If a introducer is really good, he's going to work with bigger rounds, right? He's going to raise Series B, C, D. But at early stage, it's more likely that he's going to work for a fee, for fixed fee, like Omeed said, and it's coaching or consulting, right? And those people will, build your investor list, prepare your deck, run your back office and all that stuff, but not take a success fee. Because again, I'm going in a circle now, but you get the idea. And I think that's it for, questions keep coming, but I think we have to call it a day now. It's 1 a.m. here for me in Asia. And Omeed, I don't know if you had breakfast yet, but personally, I'm going to grab something before going to bed. Omeed,
Thank you so
the last
much.
word is yours.
Awesome. Yeah. Thanks everyone for joining. I love talking about this stuff. I love working with startup founders. Don't hesitate to reach out. I'm going to drop my LinkedIn in the chat one more time. Make sure to shoot me a DM asking for the fundraising guide. I'll provide you with a copy of the guide. Steph, I'll also get you a copy of the guide as well. This has been a lot of fun. Thank you for all the questions and good luck out there, everyone. I hope that you're very successful in your fundraising efforts. I love to see nothing I love to see than founders making money. So let's go out there and crush it.
Thank you, Omeed. Thank you, everyone. Bye-bye.
Take care.